Now, as our usual, we'd like to remind you, please like, share, subscribe. This is going to be an interesting segment as we start talking about China. What is some of the policies that we're seeing within China? What a Biden presidency is so far indicating in terms of where their views on China will go. And some of them have been pretty consistent where we started in terms of where Obama left off, where Trump picked up, and now where we're going to kick off 2021. So there's a lot of things in this. So we'd like to hear from you. What are you seeing maybe professionally, in terms of trade back with China? Are there delays? Are there some issues? Or just are you trying to get away and look about supply chains in Vietnam and some other areas? This I think would be an interesting time to open it up and really hear back from our watchers, listeners, and what they're seeing on the ground. So here, when we start looking at China's business cycle accelerating, again, the business cycle in general is the one where there's the blue line as we see a wave back and forth, and the credit impulse is, I think, very important to understand what are the impulses overall. And we're going to talk about how the PBOC and the CCP has talked about trying to cut back on new credit and trying to tighten some of the issues what are the issues? The issues are this extensive debt bubble that has been just continuously expanded over the last 15, 20 years and has really gone into overdrive over the last, let's call it 6 to 7. So this is, and this 2008 to 2010 is again showing you kind of those increases in bubbles, and then obviously we had another big increase in stimulus that came through 2016. So the credit impulses, as we look at the 3-month advance, is starting to really roll over. And if you look, every time it rolls over, so does the business cycle indicator. Again, pointing to the pain or the problems that we're going to see in the GDP number. And they're talking about targeting about 6.5, 6.9%, but they're okay with 5%. And that's some of the differences that we're seeing in terms of these targets, where the targets are softening up a little bit because it's going to be very difficult to maintain some of these targeted rates and growth rates, especially as obviously the numbers get bigger and the stimulus needed to maintain that growth as the consumer remains soft within China. Export subsidies are becoming harder and harder to subsidize, and that infrastructure spend is again very long in the tooth. And instead of getting this kind of pump it until it breaks, they're trying to mitigate some of those issues that we've seen out of the USSR and some of the other stimulus where you just overheat. And I think this is going to be an interesting time. And now with the rise of COVID cases, the limitations on movements throughout the country, that's going to be a way to point to something and say, oh, see, we had to do it because we wanted to adjust against COVID. And another interesting data point, and this was one that I thought was very interesting, is the debt service to official bilateral creditors will impose a heavy burden on different countries. And who are the ones that are going to receive payments? And that's why this is an interesting annotation. The source is at the bottom. I highly recommend going to it, because a lot of people will like to say, well, the Chinese debt problem is local. Okay, it's local. I'm not saying they don't have a debt problem that's local, but let's look abroad. Well, let's look at some of these countries that have seen a significant amount of investment and who's at the forefront. And Angola, Ethiopia, Kenya, Ghana, Zambia, Cameroon, Mozambique, Pakistan, Myanmar, they're all China. So when we look at the emerging markets and the debt that they need to incur in some of these areas from China in general, and we've seen China take delivery of ports, which we'll talk about and highlight in a minute, how we've seen them take a big, they've already taken over some of these assets as they've defaulted, but the revenue's not there. So you have a debt level that you've created. You've tried to take payment from the country, and now the country's saying, look, we can't afford it, and even your estimates on revenue are still too high. So you're going to have to take a write down. And as these write downs mount, there's going to be additional fears. Like let's look at Pakistan with the Pakistan-Chinese economic corridor. We have issues happening within China and India, and it's in this Kashmir, Ladakh area. How are we going to see this movement of goods from Pakistan into Western China with a lot of these issues that continue to arise? And given they've slowed down, because what do we have? We have winter. What does that spring thaw look like? And does Pakistan have the economic means right now to pay back China, given the amount of South Asian? And when we think about who has the most exposure, it's China. When we start looking at Bangladesh, China's up there as well. Russia's a big one as well. These are things that we have to really understand and appreciate when we're looking at it, and not to just pick on Pakistan, because when we look at Africa's struggling. We talked about in the very first segment on how the sub-Sahara is seeing a huge increase in poverty. They're seeing a big problem with food security. How is China going to get these payments? How are they've made all of these investments. Is it going to benefit China mainland, or is there going to be a debt shortfall that's going to have to be appreciated, or at least a mark to market that will hurt some of this capacity? Now, when we look at consumer spending, because consumer spending is going to be a big focal point for us as we go through the Chinese data. So when we look at since 2010, China's had a huge increase of 171%, which obviously they should. Why wouldn't they, given the fact that you're coming from a very small number to a still small but bigger number? So the percentage jump is huge. And on the U.S. side, we're at 35%. So clearly you had 18 into 19. And then, as we were saying, back in July of 19, we started to see those cracks that came through. And then obviously COVID was that jet fuel on the forest fire in 20, which shrunk those retail sales. Now, China has maintained some growth, but you can see it starting to flatten out. And that's why when we start talking about Chinese policy, it's very important to appreciate why are they doing that dual circulation strategy? Why are they trying to incentivize the local consumption? Because they see how it's really slowing down. And if you want to generate that type of economic growth, as everyone keeps saying, oh, COVID has sped up China to catching up to the US. Well, has it? At what point do we get the pivot? When do we get that private investment? When do we get that consumption as we see those debt issues that are continuing to arise on the Chinese side? Again, is just going to weigh on how quickly China can not only try to overtake the US, but also do it on a sustainable path, given their debt levels. Now, not to say that U.S. is in any great shakes on a debt level, but China's at a worse level. And how is that going to look as we start to see some of that stimulus come out of the market? Now, when we look at some of the Chinese numbers, so GDP, the survey for Q4, 2.7, actual is 2.6, GDP over year, 6.5%. Year to date came in at 2.3%. So technically growth, but there's cracks within those numbers. And it's much closer to either zero to slight decline. And it's just because of how they're moving that needle. And we'll talk about, how much it's been moved over the next couple of slides. So industrial production was expected to be at 6.9%, came in at 7.3%. Retail sales were expected to be at 5.5%, came in at 4.6%. Retail sales year to date was expected to be down 3.9%, came in with estimates. Property investment was supposed to be at 7.2, came in at 7. Fixed assets ex rural was supposed to be at 3.2%, came in at 2.9%. So you're starting to see the cracks. And now, mind you, this is with restruck numbers on a year over year level. So they took down, and we'll show the numbers going back to 2010, they've taken down these private investment, the fixed investment numbers, and yet they're still missing on some of the year over year. And I get it, you can't adjust too much, because then you're like, well, this is natural adjustments that we should be making because we have new information. Now the data is complete. We've gotten better at collecting it. So we're just restriking the older data to come in line with the new adjustments. It's like, okay, well, but then what does that do to your GDP previously and in the future. What is that going to do to your expectations as the consumer is clearly slowing? Survey jobless rate expected at 5.2, came in at 5.2. Again, more of a communist nation, so you can, obviously adjust that jobless side a little bit easier. But the fixed assets, the property investment, these are where we're going to see, as the PBOC cuts some of these directives on injecting capital, on injecting debt and loans, that's where you're going to have to watch, because retail sales is going to struggle. We know that. The property investment and fixed asset side is where we think it's more pronounced on some of those problems overall. Industrial production, that's going to come down to the supply versus demand recovery. Supply side has been better, as obviously exports have been strong, but imports continue to disappoint. And the import side is the one that leads to how is the retail local consumer, and how much of the raw materials, semi-finished products are you buying to export later on? And that's where we continue to see this bifurcation in general. And that's where we have to appreciate and just kind of looking at some of the margins overall. So the record jump in China's global GDP share was just one among many milestones. Again, the economy converged with the U.S. at the fastest pace on record. That's China's GDP was 71.4% of U.S. levels in 2020, according to the IMF, up 4.2%. The share of global trade increased as pandemic-related exports surged, but again, supply versus demand in terms of that recovery. And they were already at the world's top exporter. They increased their total market share of 3.6%. Total world trade likely contracted 5.6%. So they picked up 3.6% of a pie that shrunk 5.6%. And the cost of doing that is increasing. So by increasing the cost to do that, you're going to impact because it's going to be financed by debt. It's going to be financed by some sort of loans that are originating at the underlying level, which is going to have to adjust as those import prices are increasing exponentially from copper, iron ore, coal, those raw materials, which are going to continue to weigh on some of those investments. So China likely regained the title of the world's top destination for foreign investment. Again, we're going to have to see how that shakes out, with foreign investment in China reached more than 130 billion through November, slightly above previous year, but FDI flows are likely to have fallen 30 to 40% year on year. So again, we're seeing this changeover in terms of where is some of this direct investment going, or that foreign direct investment overall, because globally foreign direct investment fell 30 to 40%, but China saw an increase of 130 billion in terms of just those movements. So again, that was a positive in terms of injecting that capital, but how is that going to adjust as we head into the new year and we see some of the issues that are arising? Now, the Fortune 500, the full year, it continues to fall. Sovereign debt was added to the FTSE in terms of completing the country's inclusion in all three top indexes. Foreign investors bought 1.1 trillion yuan, or 170 billion of Chinese bonds in 2020. Again, some of that inclusion. But when we look at rebar margins, so let's look at hard-rolled cold steel on the margin. If we look at the HRC, you can see the US dollar per ton has come off hard. Rebar margin is now negative. And when we look back in 19, again, we started to get that concerns in July of 19. Then we saw some recovery, and then obviously we had the slowdown into year end. But now the supply chain issues are real. And as the supply chain issues continue to grow, we're going to see that pressure on the margin. And how long can these guys operate at such negative margins, trying to maintain their export market at this point in time? And that's why, again, these are the issues that we're seeing permeate through the system that is just going to weigh on just general activity on the internal side, because we know that steel has increased overall, HRC activity has increased overall, but there's not a lot of demand abroad. And as you're trying to subsidize cost, at what point is it just too much? And then, then that's going to help Germany, that's going to help Australia, Korea, India in terms of getting some of that steel out there. But these pivots are going to be real because at the same time, it's also hitting local building. Rebar is something obviously that's going to be consumed locally as well. As those margins come down, you're going to have to push through price increases, which is going to hurt domestic consumption as well, or domestic numbers. And if you think about how fragile some of this investment is going to be, it's going to be hard to see some of this support as we go through the remainder of the year, which is why when we look at China's share of the global economy is expected to grow and obviously shifted higher after COVID, we are questioning how sustainable is that and how much debt is required to maintain these levels, given those impulses are starting to come down, given that we're starting to see the PBOC, starting to talk a good game. Now, there's some commentary that it won't be as strong, but again, the PBOC knows that there's a bigger issue, and if they want to be a bigger player on the bond side, they need to essentially strengthen some of the underlying issues. And that's why when we look at liquidity injections, we've seen a big spike into January. So they're saying it, but we're still not seeing it. But just in terms of the rolling 6 months, there's a lot of opportunity to take liquidity out of the market, which is why we look at the repo rate constantly, which is why we're always looking at these assets, because there's a lot of ways that the PBOC can pull liquidity out of the Chinese market fairly quickly by looking at repo, like what is put back into the market, what they take out of the market, and that's a way to adjust some near-term liquidity, which we expect to happen in the near term. But when we look at, again, container rates out of China, coming into Shanghai into LA, you're seeing it flatten out at that 253. Shanghai to New York is coming closer to that LA level, but Rotterdam is exploding, and you've seen that big acceleration into November, and that's where we're starting to see some of this rollover and some of this normalization. But again, this is also price. And rail rates to haul goods to Europe from China have more than doubled because of tight capacity. Shortages of ocean-going vessels continue to push more freight onto rail networks, which is where we've seen more rail coming from China into Europe. Some of the two different ways that we've highlighted in other shows. But in the Shanghai, Europe, air freight costs are up more than 90% week over week, according to the TAC index. Again, there's that supply chain problem, which is going to increase input prices on the receiving end. Strong consumer demand for products from China continued to push those issues moves higher, but how much of it is from real demand versus inventory rebuilds? And again, it's more inventory rebuilds than that actual demand. But as a result, there may be even more gains ahead for companies that are looking to move those cargoes. And that's why we keep talking about trucking, we keep talking about rail. There's still some of this movement because there's this shortfall as they try to move some of this product through the market, but it's going to lead to more prices. And as prices go higher, not only at the local Shanghai level, but also at the entry point of LA, New York, and Rotterdam, that's going to just push that system. And again, inflation going higher as wages don't adjust. So here, when we look at, again, as we talked about with the Chinese exports, so Chinese exports 10.9, Chinese imports are down 0.2%. Then you look at Chinese trade balance at an all-time high, but that looks great because exports are strong, but at what subsidy? As we see those imports slowing down, because imports are going to be, as we've seen those imports, have that big spike and now a pretty steady decline. And this is looking at CNY to keep apples to apples, looking at the local, which is why in order to move some of those imports, you would think that the CNY has strengthened, that should increase imports. It hasn't. Exports should have weakened based on the strength in the CNY. It hasn't. But there's going to be this movement on FX rates that is going to have to adjust to essentially keep those exports flowing. And that subsidy becomes a much bigger onerous push. But let's look at the trade war. So there's different ways to look at the trade war and how effective was it overall. So Chinese imports from the U.S. as a percentage of the total has increased, and percentage of U.S. exports going to China has increased. So we've seen those increases, but it's not so much because of the trade war, not because of the trade war. It's more because of this shortfall in the overall supply chain and this surge in just movements back and forth as we have these bottlenecks. So that's why we think that there's going to be a much bigger issue when we start looking at how is the PBOC going to stimulate while trying to pull some of the liquidity out, and how do some of these tight margins driven by rising import prices, because imports are down, so they're clearly pulling from inventory. And given where we're seeing copper, iron ore, coal, all of these raw materials continue to drive higher, where does that adjustment really come in? And when we look at the exposure, this is where we start looking at Chinese investments in African ports as we look at those raw materials, because the raw materials are seeing supply constraints. They're also seeing some of the demand increases overall. So, but on Monday, just to look at some of the issues, the U.S. and Chinese militaries typically participate in what's called the Military Maritime Consultative Agreement, the MMCA, which is a 3-day summit to discuss safety mechanisms. As we've know the issues that continue to arise within the 9-dash line, the overall issues within the region, but at least that was planned until the representatives of the PLA didn't show up. So the MNCA has typically been held twice a year since '98. According to U.S. sources, this is the first time PLA has no-showed. Again, the increasing problems we're seeing at the local level within not only just around the South China Sea, but also increasing into other areas because China has invested in these African ports. So the trade lanes continue to expand, and China is looking to enforce not only their rights for some of these islands, but also some of the ports that they have owned, they control, they continue to shift around. But how you can see what they're operating, but you can see what they funded, and now what are they operating and funded? Some of these countries are struggling, and as they struggle, how are they going to pay back some of what they've borrowed, especially with South Africa, which when we talk about South Africa, mining production is down year over year, month over month. They're struggling overall. So there's less throughput, again, coming back to supply, increasing the cost of raw materials, but also declining port revenue. And this is where we continue to see some of these issues that are arising for China in the African nations, but also the stress that's continuing to increase between the PLA and the U.S. military, more specifically on the naval side. So what is going to be done? What are some of the things coming up overall? So when we look at the next People's Congress, which they're talking about increasing the amount that they meet. So it's going to start today, complete on the 22nd. And what are some of the important things? Legal aid law, licensed physicians law, wetlands protection, family education, workplace safety, Coast Guard law. There's a lot of things to be talked about. But what are the 3 things that stand out the most? And I think Trivium did a great job of covering this. The first is there's a clear focus on the redistribution and addressing inequality. Again, back to the point on the consumer. Xi specifically said that officials need to address regional inequality, urban-rural inequality, and income inequality. Second, building self-sufficiency and technology is a strategic imperative. We covered this in our show called the Chinese Communism Rising. The government will identify technological choke points and task companies with addressing them. So again, we have supply side, we have demand. These are the big components, and this is all wrapped into third, financial de-risking is here to stay. Deleveraging, reducing overcapacity, and reducing housing inventories all remain high priorities and are a clear signal that credit growth will remain constrained and restrained in years to come. Again, pulling stuff out of the market, fixed investment, real estate, while trying to drive down inequality and increase demand domestically through not only demand reform, but supply reforms. This is going to be a big pressure on redistribution. Where is investment? And this is something to consider when investing in China. And what does that mean? Well, let's look at is this going to impact what is happening within the new RCEP deal? What is the U.S. government going to look to do? And when we look at the program the one on the left is the number of operations of the freedom of navigation. So in 2015, with our pivot to Asia, which happened under Obama, and which I think President Biden is going to continue to carry through, the program escalated with, on average within a year, we had about 5 passages of freedom of navigation. In 2020, that increased to 8, with 19 being 10. I don't see that adjusting, because when we look at 15, 16, we were already increasing our passages. And now when we look at the freedom of navigation operation in the disputed islands, you can see where we're pushing through and showing where we're willing to continue to push and highlight that this is international waters and it is owned and or controlled by other nations. This is going to be a friction point, and the fact that China didn't show up to the Maritime Council is just showing more and more strain along these levels, which I think is going to continue to push these operations, even in a Biden administration. This isn't Trump or Biden. This is military specific, and this is going to be a continuation from one into the other. So when we think about these different push points and what is happening in the coast, let's take what we know that's happening on the coast in some of these sprightly islands, what we know is happening in Africa, and now let's round this out. So the year ended, again, that's 6.5%. Just to rehash, that's up 4.9% year over year growth. By sector, the growth in primary sector was up 4.1% versus 3.9%. In secondary sector, up 6% versus 6.8%. Growth in tertiary sector, up 6.7% versus 4.3%. So we're getting this increase in growth. But despite the good news, the big caveat remains it was heavily reliant on capital and expenditure and industrial output. Fixed asset investments rose 2.9%. Value add output at industrial firms increased 2.8%. But retail sales fell 3.9%. So again, supply, not demand driven. And that was really driven by capital expenditure, which was financed by liquidity from the PBOC and local banks. We've seen an increase in bankruptcies. We've seen increased strain on debt. That is going to come out of the market as they try to normalize. And there's another worrying stat, which is household consumption expenditures fell 4%. In real terms, despite the 2.3% year-over-year increase in GDP growth. So household consumption was a net drag on the actual numbers, and it's unlikely to see that growth and that snapback because the consumer continues to struggle overall. So in December, as we've talked about, the headline components continue to be weak, with retail sales, down up 4.6% year over year, but down 5% from the 5% in November. Value-added output, the weaker retail sales numbers underscore the unbalanced recovery components. And this is concerning for several reasons. Strong growth in fixed asset investment in industrial production will be hard to sustain as Chinese officials withdraw that stimulus and seek to normalize. Credit growth fell sharply last month. As we've been talking about, credit growth continues to slow, which will weigh on capital expenditures. Real estate investment growth slowed to its weakest since June last month of 9.2% versus November of 11.5%. So again, that money's coming out. Infrastructure investment in December increased at the slowest pace since March at 4.2% versus 5.9% in November. Again, monetary policy is going to continue to shrink because in 2021, monetary policy should be stable and not make sharp turns, according to Sun Quanfeng, director of the Monetary Policy Bureau. Again, these are things to think about, especially when we start to look at how are we functioning in these military facilities. So China has built out these facilities. They continue to try to push the U.S. Navy off of their coast, try to show force and really trying to help themselves in not only the RCEP trade deal, but also within Africa and trying to maintain some of these lines. So when you think about, okay, well, what is Biden going to do going forward? The geopolitical futures had a great statement. So on his last full day, Mike Pompeo labeled China's treatment of ethnic Uyghur Muslims in Xinjiang as genocide. This is the first time that we have said this is straight up genocide. The declaration isn't one to be made lightly. The U.S. is the first country to make such a determination. So you might say, okay, this is Mike Pompeo rattling the cage, Trump's final, hurrah before leaving. But here's the important part. Notably, though, incoming Secretary of State Antony Blinken said during his confirmation hearing on Tuesday that he agreed with the determination. So this means that Pompeo looked at his successor and said, I'm doing this. Do you agree? And they said yes. So if you're thinking Beijing is going to get this new hope, no, it's going to be a lot of continuous pressure on China because this is a big declaration. Now, Russia troops just showed up to train India. So now Russian troops are training India. So India sent its first group of military specialists to Russia for training in the operations of the S-400 system. The U.S., we don't like it. You shouldn't be doing that, but we're not going to stop it. Why? Because this is just showing Russia and India continue to be allies, and it's a show of force against China. So we have the new administration okay with the Mike Pompeo commentary, supporting it, Yellen speaking tough on it. This is all going to culminate in this area. This is going to be the area to watch for the U.S. impacts. India and China, the spot to watch will be not only the Dokkan Plateau, Sikkim, but also that Ladakh. So when we think about, okay, well, let's think about these drafts. Let's think about the trade war. What does this mean as we look forward into the Biden administration? So in 2019, during the depths of the trade war, Xi indicated he wants to better leverage China's control of strategic resources, i.e., rare earths, which we've been highlighting overall. So what are they trying to do? They're trying to not only push the U.S. off, increase their competitiveness by utilizing that One Belt, One Road, or the Belt and Road Initiative, but they're also looking to leverage the rare earths. Now, the draft regulation coming from the Ministry of Industry and Information Technology is not surprising. There's nothing new in there, but it just makes it easier for Xi to pull the trigger. And as we saw in 2010 into 2011, when China cut rare earth materials into Japan, what that caused. This is just setting something up as a quick shot across the bow to the incoming Biden administration, saying, this is what we can do, just as a reminder. As Biden has spoken very well in terms, and his people or his appointees that went before confirmation confirmed, we will remain tough on China. The pivot to Asia does not end with Obama, with Trump. It will continue with Biden as well. So for the past 6 days, Foreign Minister Wang Yi has been on a tour throughout Southeast Asia. On Monday, heads of the United Front work departments from across the country met up in Beijing. Wang's remarks underline a shift in Beijing's ethnic minority policy. The focus is now on assimilating ethnic minorities instead of granting them greater autonomy. So again, back to what we said about the genocide comment. They're now coming out because over the past 6 days, Foreign Minister Wang Yi has essentially said, nope, we're going to continue the course that is now being fraught with problems as Europe has called for human rights violations. This is going to Hong Kong, Taiwan. The U.S. has opened up Taiwan in terms of what we're willing to do. And again, Trump did that right before leaving because he's essentially saying, look, this is what should happen, and it's up to you now to reverse it. And I don't think Biden's going to reverse because this is, again, the natural trajectory that we're seeing. And so what does that mean for trade? So when we look at Yoi's got a big to-do list when we're thinking about the trade is currently in negotiating, because China is currently negotiating several free trade agreements. And again, there's a lot to be had because right now they're trying to do it with not only China, Japan, Korea, trilateral FTA, or free trade agreement, but Gulf Cooperation Council, Norway, Israel, New Zealand, Panama. There are a lot of things that have to be accomplished. Now, there's a lot to be done, and the U.S. is not going away in terms of what our trade imbalance will be and what that will look like going forward. So the 7-day Chinese New Year holiday travel rush, the world's largest annual human migration, begins February 11th. Again, these are things that we think are going to adjust overall. So now when we look at some of the rehashing and the readjustment in general, we have to look at what China has steadily revised down historic fixed asset investments. Now, this doesn't directly impact GDP, but it is a big component of that investment side, the government side, and how they're going to try to massage. And you can see how the originally published is the blue, the revised as of pre-Jan 18th is the dark blue, and then the revised is on January 18th. So they continue to take down numbers, and they're increasing what they look to be those year-over-year growth. That is the underlying problem. This is why we continue to question what the GDP number looks like, because this is going to be a big impact into the debt side, into those different components. So that doesn't matter too much in the grand scheme of things. What's a few percentage points, but the extent, scope, complexity of these revisions suggest high degree of political anxiety over the economy that could influence future stimulus and expansion. So even though the PBOC is saying this, are they going to be pushed into continue stimulating the market in order to keep these numbers, or at least achieve this perception of growth and maintaining some of the market share that they've gained? Which is why Chinese infrastructure spending year over year. So when we look at the infrastructure spending year over year, you see that huge surge in terms of the investment in 2020 off of those lows. But look at iron ore prices. Again, this is the inflation. This is the move that we're going to see where, that's why this rollover in infrastructure spending, not to say it collapses back to those 2020 levels, those March, April 2020 levels, but it's just going to normalize and not be able to hit the 2018, 2019 levels, especially with iron ore prices surging to the levels that they are. Now, China continues to buy monthly soybean imports. Again, looking at these imports that remain strong well into 2020, driving those prices higher, but also hurting the local consumer because prices are going up. And if they're not going up, it's because it's being subsidized by the Chinese government, which is why when we look at China's cumulative soybean imports, again, smoothing that out, they finished 2020 strong, and they're starting 2021 just as strong. And it's going to be at that new seasonally adjusted record going back to 2014. But when we think about what the oil and gas licensing blocks by country look like, you can see the pressure between Vietnam and China. This is why we keep talking about it, and we're going to keep rehashing the pressure that we're seeing on freedom of navigation, on the impacts. We know China has sunken several Vietnamese fishing boats. They've chased away Russian assets as well as Vietnamese assets, that were doing seismic as well as drilling. This is where that pressure is going to remain, and there's going to be a lot of pressure between China and Vietnam in the near term, and that bleeds into Malaysia as well as the Philippines. Now that we've talked about some of those components, it's important to highlight, because someone brought up some good points in last week's episode where looking at India data. So there's some benefits in terms of where India data is looking, but we're trying to talk about the index, the lockdown index that hasn't gone down. So they're starting to see a little bit of a reversal in new active cases. Again, the new COVID-19 cases is continuing to trend down. We're starting to see that flat line, and that lockdown index is paramount to keeping things under control. But consumer sentiment remains weak, but again, within this 50 number, which has been there since let's say the end of November, and has maintained this level. It's not going to see that pop higher with retail and recreation under pressure, with flight departures, and this is what we've been saying is going to continue into January, and it was confirmed with the sale of diesel, the country's most used fuel and proxy for economic health, dropped during January 1st to 15th by 6.6% from the same period in December, and 3.5% from a year earlier. So we're down month over month, and we're down year over year, just showing that there's still some stagnation in the economy. There's still some slowdown. Exports are starting to flatline a bit. Again, those import-export sides. Sales of gasoline, jet fuel, and liquid petroleum also declined month on month. So again, not only on the diesel side, which is industrial production, movement, but also some of that softness that's coming into the gasoline side. the retail side and the residential side. Again, this is just showing that while India has recovered, and as we talked about in the mobility index, it's gotten higher, or I should say the high frequency index, it's gotten better, but it still hasn't crossed over that threshold. It's still 20% or so off of year over year. And it's still not even back to where we were at the end of October, as November and December has gotten better, but still not October highs, which is when Diwali and the holiday season was. It's just we're still struggling to get back to that point, which is when we start looking at India merchandise trade balance. Is at a low. Survey was 15.7, came in at 15.4. Again, this is the trade balance. This is when we're starting to look at exports, imports. Where does we see this merchandise trade balance looking to go? And this is something that will start to get better because we think exports slow a bit, imports where imports dip, but exports should start to increase a bit, and this will help kind of adjust this within this average, because it's not crazy off. It's just something where it's going to be closer to down 10,000 overall. And now just rounding it out with Japan, because Japan continues to see these lockdowns. We're seeing additional COVID cases increasing. That's putting that lockdown index back to highs. And we see walking transit, nationwide transit, just people are slowing down and doing less. And this is in Malaysia, this is in Indonesia, this is in Korea, this is in Japan. And again, coming back to India, which we're just seeing some of this slowdown. And it's not that it's going to have a huge shift down in economic activity. It's just not going to support a normalization, which is something that we're seeing also way into China. And this is just looking at some of these orders. So Japanese machine orders, private sector was down 11.3%. Machine orders, private sector was up just about 1.5%. Total orders were essentially flat. Tokyo business monthly vacancy rates are starting to climb higher. Again, the pressure that we continue to see in this market is only going up. And again, it's just, we saw a spike and now this slowdown in general. So when we look at Japan's cyclical recovery, it continues to lag overall. So the U.S. had that spike really driven by those supply, the logistical issues. Then we saw the China, again, starting to slow down a bit. But the UK, Euro, Japan continued to suck around this contractionary kind of flattish number. And that's why when we start looking at the largest countries in the world and as they continue to struggle to normalize and really starting to slow down again, that's going to put that headwinds on the just global economy in general. So I know this was a long segment. I apologize. There's a lot to talk about given Biden, what's happening with China, how is this going to impact things going forward. So this, I think, was a good kind of refresher on some of the information out there. Have any questions, please let us know. There's a lot in here that we can unpack in separate shows. Please let us know if you'd like us to go in depth on more. Watch us on the pregame show when we with David Rams and Wood, when we go through some of these hot topics and really dig in, and then he brings in his own specialists as well to go deeper into specific topics in general. So thanks again for watching. Stay tuned for our EIA show coming out on Thursday, and then obviously everyone's favorite, the Primary Vision Frac Spread Count show on Friday. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.